Let's quickly take a look at the market. 200-point down on the Nifty, 23,230 is where we are at. We have taken out the November lows as well, but we've kind of clawed back slightly from the opening lows. But on that note, a big market voice, as I had promised at the start of the show, joining me is Sunil Subramaniam, market expert. Sunil, Happy New Year, but looking at the screens, none of us are feeling happy. Of course, 10% off highs, entered into the correction zone once again, and we are right. We were in where we were in the month of November. How's the mood?
Well, obviously the mood is nervous because I think it's a big event filled the next couple of weeks. The Trump inauguration, the economic survey, the budget, and then the earnings season would probably a third of the earnings season will be done by the end of January. So I think with so much of uncertainty around, the risk premium has shot up in the market, and especially FIIs, right, are in a situation where Trump is causing nervousness every day with this kind of announcement. Now, there's a lot of noise created by the Trump administration, not the administration yet now. But when come Jan 20th, when he takes power, how serious are some of these actually going to get implemented? So there's a market is very, very nervous about that. They are unsure. And right now, US debt seems the safest bet for an US based FII because he's getting 4.5% risk free, currency risk free, default risk free. So he's probably sitting on this cash waiting for these events to play out. There's no India specific trigger. We are coming off a period where our GDP is disappointed, earnings season disappointed. There are expectations this earnings season could be better, GDP could be better, but the previous earnings season and the GDP numbers were not anticipated by the market. Market being taken by surprise is now hesitant to make a strong call on that the earnings season will be better or the GDP. RBI governor did say that from 5.4 this quarter would go up to 6.8. But like I said, once bitten, twice shy. Previous time, the RBI governor had stuck to 7.2 as a year's target, and then he revised it down to 6.6 in his last policy. So a lot of this means that, and then the government also, the statistical part has come and now revised the figure for a lot of the gold imports and all of that. So there's a question around the veracity of the data. So I think there's too much uncertainty right now, and I think investors. And the important point is the FII action, while it's justified because of all of these, and also the fact that Trump has now suddenly put sanctions on the Russian vessels, and he's forcing Europe to buy US oil. So oil prices are shooting up. So India specific, you can understand that FIIs are nervous, but domestic fund managers, in reaction to this, are also sitting on cash. They're also not buying. In fact, they're booking profits in the small cap and mid cap and keep waiting for the earnings season and the budget to give them direction. So right now, it's just nervousness prevailing all over.
Well, rightly pointed out, nervousness all across the board, and we've seen that nervousness particularly play out in the broader end of the markets, right? Clear pain. I don't want to use the word panic, but if you look at the movement since last Monday or last Friday, so to say, we've seen, including today's move, we've seen an 8% cut almost on the Nifty mid cap index. Some of the stocks have shaved off as much as 15 to 20%. So that's the kind of nervousness that's there. So when one does start deploying funds, do you think large caps would be a safer bet? Do you expect the leadership to come from there? Because even now, even the large caps are not taking the leadership.
No, that's because I think, like I said, large caps are an FI dominated space, right? And even the large cap fall would have been much worse if not for the IT helping soften the blow. So, yes, I do expect that the recovery will start from the large caps for the simple reason that I think that it's the FII flows returning to India in whatever form post the earnings season and the budget that are going to drive the market. And I see domestic fund managers, the fall has been caused by domestic selling because FIs don't play a big part in the middle small cap segment. So clearly, domestic fund managers are worried about the valuations. They are booking profits. And when they redeploy, whether they put it back in mid cap, small cap, or large cap, would depend on these numbers. Whereas FIs are clearly going to come in, and whatever buying they do, even if it's little, is going to be in the large cap. So many stocks are off their 52-week, on their 52-week lows. So in the large cap space, there's comfort. And I would say that the first step of buying from FIS, obviously it's going to be in large cap, but even domestic fund managers, I would expect that they would step in and buy large caps where the earnings guidance. So the earnings season also, there's a quarterly earnings which is for the past quarter, but there's a guidance for the year, which is very crucial. So I think those where the guidances
Yes.
are coming good. See, TCS results we talk about, right? It's not just the good earnings; it's the guidance that came through for the overall IT sector got impacted. So I think definitely large caps are where the initial rally will happen.
Since you mentioned TCS commentary, if you look at the positives and negatives for the IT sector, there is a sort of a tug of war still, right? Commentary has been good, rupee tailwind is there, deal wins have also been surprisingly good if you look at TCS. But Trump policies do pose uncertainties, right? Because even in terms of rate cuts, some of the brokerage notes I was reading said that there may not be any rate cuts, Fed rate cuts this year at all. So how would you balance it out, the positives and negatives? And in that light, how would you approach the IT sector?
So I would say that I think the rupee depreciation part is overdone because I think the dollar strength is overdone. And I'll tell you why. The dollar is strengthening because of money flow into US treasuries. The dollar is strengthening because the rate cut scenario has now kind of paused. Earlier there was 4, then there's 2. Now you're saying no. There are some parties saying no. But it's also that the Trump actions are indicating a stronger US corporate sector and hence corporate earnings, and so there's a positive entry to that. But bear in mind that for Trump to succeed, he needs a weaker dollar, not a stronger dollar. If he wants Europe to buy American oil, the landed price of American oil in Europe has to be less. So the dollar has to be weak. So while generally one associates saying Trump MAGA with saying America is stronger, it doesn't mean that he wants dollar stronger because that's going to hurt American exports. So I think that the dollar rise, I think, is overdone. That's my personal opinion. And I think that it will ease. So from that IT sector, the tailwind from depreciation, I think the extent that the market is expecting that, I don't think it's going to happen. That's number one. And even if it does happen, the buyers for IT are the big corporations in the US. They will negotiate down the price to make adjustments for the depreciation, right? That's the bargaining power. So I think that's a bit overdone. So it's there, its effect is there, but not as much. But it's the deal book which is, I think, positive, which means that if America is going to get a revival due to corporate tax cuts, due to supportive Trump policies, then their IT buying will step up. Not only because over the last few years they haven't done much, post-COVID they did a bit, not much, but the AI, every industry today is facing the pressure from AI and they need to adapt to AI. So that needs a lot of consulting, needs a lot of rebrushing. So I think IT companies on a strong wicket, those which have got the AI capabilities on consulting side, are probably going to win a lot of orders in the coming years. And so, to me, in a balance, IT still continues to be a good pick, like I said, for that reason. And I would focus myself on those companies where the AI level of advice and consulting strength is there. Those would be the ones who win, not your traditional IT software, outsourcing kind of a work. And the other thing is that I think market has also recognized that this whole immigration piece is not going to affect so much the H-1B issue, because I think Trump is after illegal immigration and then the low-end immigration. These are high-end workers where America needs it, and America corporate is making up with Trump big time. Though they opposed him in the run-up to the election, today they are making up. So I think you could see that Trump will definitely be favoring corporate America, and so those things, they will want the H-1B, because not only from a perspective of them improving their performance through partnerships with the IT companies, the fact is that, the GCC kind of a work also, right? That will also get a boost because it's American companies which are coming and setting up the shop in India, will mean that the exports will be from India but by an American corporation itself. So to that extent, I think the GCC thing will continue to grow.
Right. I want to also get your thoughts on, what happens to the China plus one benefit that we were looking at, because Trump, so far he has emphasized on making America great, make in America, so to say. If that happens, do you think, China plus one as a theme would take a backseat, or do you still see, some bit of value in or some kind of recovery in China plus one as a theme, like chemical stocks for one? Would you look
No,
at
I
that now?
definitely see value there because of the fact that we all, market is expecting or initially is expecting that China would get hurt by the tariffs. But please understand that China is not sitting quiet. China has bargaining tools on its side. First, the US can't cut off imports from China. Okay, number one. Number two, China holds a huge amount of US dollar securities, treasuries. So they have a currency to fight, right? The dollar strengthening means the yuan weakening has actually helped the Chinese cause. To that extent of the dollar strengthening, to yuan weakening, the tariffs will have less impact, right? That's second point. The third point is China is rapidly building up its capabilities outside of China. So what they're doing is they're tied up. Obviously, Vietnam is a big, big partner for them. But I see India also making a play. So I see China plus one becoming China plus one in specific sectors, pharma, API, chemicals, a lot of these places. What will happen is a bulk of the manufacturing will be done in China, and they will try to finish it in India. And I see that India is moving politically towards that. That's why we had the border situation easing up. We are talking now. So I think that the pragmatic approach for India also is to partner with China, and the product is finished in India and sent out. If they 70% or 60% of the work is done in China, and the finishing part of 40% comes to India, and then the product is made in India, you the differential tariff, right? Now, why Trump is well aware of this? Why will he allow that? Because remember one thing, tariff is a threat. But if implemented, it means US inflation for the retail US consumer is going to rise sharply. A new president doesn't want that happening. So the balance between strong talk and strong action, right? They say, the dog that barks a lot doesn't bite the most. So I think the Trump administration in coming to power will take a pragmatic approach. All these noise levels will come down. There will be, and Trump is a very good businessman. He will negotiate hard. He will get on the negotiation table with China, with India, with everybody. Nothing is going to be free. So, but overall, America as a country is heavily dependent on importing from the whole emerging market space. And they can't afford to make in America and sell in America. So what Trump will try to do is make in America and export where those products are needed, like defense, for example, to India, like oil, for example, to Europe. So those the way the trade arrangement. At the same time, core products where labor cost is important have to be imported. The US is at $80,000 per capita income. China is at $13,000. India is close to 3,000, 2,800, 3,000. This huge difference in per capita income translates to a similar difference in per capita wages, though productivity factors have to be taken into account. So there's no choice for Trump America not to buy. So the point is, it threatens a 60% tariff. Part of it gets taken away by depreciation of the yuan. Part of it, he will negotiate with them, saying approve the price reduction. So overall, there is going to be a balance. So to that extent, this story that China is going to go down because of that is also not fully true. China is also getting into robotics and AI in a big way to supplement their high labor costs vis-a-vis India. So they're also adapting to the new situation. So I think that India has to play smart. The China, already we are seeing electronic manufacturing services, it's been a success. But to spread that across a larger sphere, right? India must get on a silent partnership with China at a lot of spaces, and then we can take advantage of it. So I do think that the China plus one has to become China plus one. And I think this budget, one of the things I'm looking forward to is how are they going to use the PLI scheme in a smarter way to facilitate all of this. So I definitely see the China plus one as a continuing support story for India's growth story. No doubts about that.
All right, I think that's a very good explanation, Sunil. I mean, I want to extend this discussion even further because you've really put it into perspective for us. One final question then. I was just reading a report last week where I think CLSA had taken a contra call on the entire consumer staples space, which has seen quite a bit of pain. But that contra call was on the basis of the fact that there could be more consumer tilt in the budget. If I asked you to choose between capex and consumption, what theory would you apply here? Would you say that the government would do much more to boost consumption in the wake of growth slowdown, or would you say that the spending on capex, defense, railways will continue and that will take priority?
No, I'm in the CLSA side here. I think that the government's budget will be much more populist than previous budgets. The reasons for that are very clear. The first is that the Lok Sabha elections gave a big shock to the government. The Haryana and Maharashtra elections saw populism being stepped up in a big way and helped them win back those states. And with UP and Bihar in the pipeline over the next couple of years, I think that the government has learned the lesson that development capex, which doesn't get felt on the ground by the common man, is not worth it. So part of the reason for the government dialing down on capex this year vis-a-vis the budget is, I suspect, this. They will come out. I don't expect them to spend that 11 lakh crores they promised in the budget last year. The real estimate, revised estimate, which comes to be lower. They will show a good percentage growth on that capex. But if you see the way the rupee is spent next year in the budget, you will see for next year that the consumption part will get a boost, because ultimately government has realized that what they do spend on infra is largely coming into a construction related industry, because building ports, airports, everything, and those are temporary jobs. They're not permanent jobs creation. The private sector getting into capex cycle is what is going to lead to permanent job creation. The government has to support the private sector to come back. Now, despite the PLI incentives, despite so much, why is the private sector not stepping up? Because demand at the mass hasn't stepped up. The K-shaped recovery that we talk about means that volumes are less, value is high. So the volume segment, which is the FMCG segment, has suffered because the rural population suffers from three things. One is not enough drill down from the government through money to their pockets. Two, inflation, food inflation has been high, has been cutting into their consumer surplus. Three, consumer sentiment to spend has been dropped. Now, government in the budget, according to me, the biggest task is to reinvigorate the sentiment in the consumer. And that can happen through tax base being, whatever, the tax cuts is one way to affect the lower middle class. The second is some amount of giveaway where the direct benefit transfer comes directly to because when that mass market consumption steps up is when capacity utilization will step up, and then private sector capex can step up. So I'm strongly of the view that, and consumption, like you said, hasn't performed. So there's a value-based approach which supports consumption. There's a budget expectation base which supports FMCG. And I think that if the government is smart and has its right, and I think domestic fund managers, the DIIs, would prefer this. Yes, and the tax collections have been comfortable enough for the government not to suffer on the fiscal deficit target. They might, for the future, project a more aggressive target. But for this year, I think without losing out on what they promised as a fiscal deficit, they will be able to enough room to take care of the consumption bit and bottom of the pyramid part, which is why I think that there's a safety play in buying consumption. And if the budget really clicks all the results, we could see a good runaway rally. So I'm with the CLSA report there, and I broadly feel that smart thing for the government to do is to mix development and populism. So developmental populism, if I may frame that word.
Sure, very, very interesting conversation. I really don't want to leave it at that, but we don't have time. And I hope we can connect again once anytime before the budget. But with that, Sunil, thanks a lot, as always, for taking out time and putting things into perspective for us. Appreciate your taking out time.